Hi everybody, this is Patrick Donahoe from Paradigm Life. What I'd like to do today is discuss the difference between the infinite banking concept and a concept known as missed fortune. So for more information about our company, to begin, you can visit www.paradigmlife.net. There's also several other videos on YouTube that discuss some of the concepts about the infinite banking concept. Okay, so let's start. Basically, the main differences between the infinite banking concept and the missed fortune concept, okay, are number one, the objective, and number two, the product that's used. So the objective of the missed fortune concept is accumulation. It's now very popular just because of market volatility. The missed fortune concept uses a life insurance product known as equity indexed universal life. So accumulation, the alternatives to putting money into an equity indexed universal life program is a 401k or an IRA or a Roth IRA or mutual funds, etc. That's the common alternative. So looking at the missed fortune concept, the money accumulates tax-free, and the money is withdrawn tax-free until basis is hit. The equity index universal life product provides a lot of benefit, and mainly those benefits are they have a floor, which basically means if the market bottoms out, you are protected. Okay, now the equity index portion of this universal life program is tied to typically the S&P 500. So as the S&P 500 goes up, you are able to take advantage of some of those profits. However, there is a cap or a participation rate. The cap means that, let's say the S&P 500 did 25% from the start of 2011 to the end of 2011, and you were capped at 12% on this particular product. Your account would not be credited 12% or 25%. Your account would only be credited 12%. Now, some equity index universal life programs have what's called a participation rate. Participation rate is if the market does 25%, you may not have a full participation rate. So if your participation rate is 50%, your account will only be credited 12.5% if the S&P 500 did 25. Okay. The infinite banking concept is a different strategy. The infinite banking concept is for accumulation. Okay. However, it's a process by which you're able to recoup the interest that you would otherwise have paid to third parties. So I'm going to call that interest recapture. And what that means is that with the infinite banking concept, the insurance company that provides this product is willing to lend up to the full amount of your cash value for any type of purchase. So for instance, if you needed to buy a car, you could go to this insurance company and basically say, I'd like a $15,000 loan. The infinite banking concept teaches to pay back at a little bit higher interest than what you would get in the market. Reason being is because when you do take out that loan, there's no qualification no qualification. They don't pull your credit. The loan doesn't show up on your credit report. There's no required payback. Okay, and basically, as you do that, you forego the need for going to your credit union or your bank to get financing. And the amount of interest that you're able to recapture over a long period of time is quite significant. So because of the two-part benefit to the infinite banking concept, you're able to accomplish a little bit more than what you would with the missed fortune concept. Now, the infinite banking concept uses whole life insurance as its vehicle. Now, whole life insurance has a relatively negative stigma out there because of Susie Orman and Dave Ramsey and A.O. Williams, Primerica, and some of their complaints are valid. However, whole life insurance has become much less expensive, especially recently as life expectancies have gone up and you also can add what's called a paid up additions rider, and that paid up additions rider allows to have a pretty significant amount of cash value up front. So let's go ahead and start to illustrate exactly how these two products work. And in order to do this, I'm going to use a software system called Truth Concepts. You can go to truthconcepts.com to learn more about the software. So today, just for the sake of time, because YouTube limits video size, I'm going to discuss Equity Index Universal Life more so than Max Funded Whole Life. If you would like more information about whole life insurance and putting a paid up additions rider on, you can visit our YouTube channel, which is www.youtube.com/Paradigm Life, and watch the video Buy Term and Invest the Difference. Okay, so let's get going here. So first, it's probably important to look at the market history in general. Now, the typical index that's used by the misfortune philosophy is typically tied to the S&P 500, an index that has existed since the Great Depression. If you look at the average overall rate of return with the S&P 500, okay, it's been similar to that of the Dow Jones Industrial Average. So what I'd like to do is first off explain maybe the last 30 years of the S&P 500. So last 30 years of the S&P 500 from 1979 until now, there's been a relatively high rate of return, average rate of return. If you go from 1979 to 1999, there are only 3 losing years in the S&P 500 index, which is great. You have rates of return, especially in the late 90s, of 34, 20, 31, 26, 19, 26, 12, in the late 80s. I mean, there's some significant returns. Even in 1987, when the market crashed, the overall return was 2.04. So there's a lot of reasons for this, mainly because in the late 70s, as the baby boomer generation came into the workforce, there were no longer pensions being offered by companies. Therefore, individuals were required to be responsible for their retirement plans. More money went into the market through 401ks, which came about in 1979. And then the IRA, which came out 1974, I believe. So individuals had the responsibility of providing, needing to provide income for their retirement. So they had the incentive of putting money through these types of vehicles, which ultimately went into the market. And obviously, if you have more demand than supply of stock or mutual fund, prices go up. That is one of the reasons why the market went up so significantly from 1979 to 1999. Now, looking at the next 5 years, the money that went in during this period of time is going to start to come out because baby boomers are retiring. They're going to be reaching the age of 70 and a half when you have required minimum distributions of 7.5%. So you have a lot of selling going on, and obviously, if you have more selling than buying, prices are subsequently going to go down. Nonetheless, I don't want to get into the history of the market. What I'd like to do is just copy and paste all of the returns, okay, from 1979 to 2009 into a calculator that's going to show the real rate of return of this product or of this index. So let's go to a calculator here called accumulation. I'm going to put a 31-year period of time, and I'm going to paste these rates of return. Okay, so obviously we need to have money associated with this, so let's actually put in a $13,000 contribution per year. All right, now what you see here is a yield that's much lower than the average yield that was shown before, which was just over 9.5%. Now you have an actual yield of 7.05%. That is because whenever an account loses value, okay, it takes a significant amount of money to bring that back to the account balance that it had previously. So to illustrate that, let me just use a very simple example. So let's say that you had $10,000 that you had contributed to a mutual fund, and in 2011, okay, it earned 25%. Okay, so your balance goes to $12,500. Let's say in 2012, you lost 25%. So your average rate of return would be 0. Okay. However, you're losing 25% on an increased balance. So your actual balance comes down to 93.75, which is a negative number. Okay? If it was an actual rate of return of 0%, your balance would come back to $10,000. In this example, that is not the case. So looking at the real return, or the internal rate of return, it is reduced to the 7.05%. Now, an equity index product, as I stated before, has a floor and it also has a cap. So what I'd like to do is just go through year by year and put in the actual floor and actual cap. So in these negative years, you would have a floor of, let's say, 0%. Okay, so that helps things. Well, let's go back to the dot-com bust, which was the early 2000s. All right, that helps things significantly. Now you have an actual yield of 12.25%. However, as I stated before, these policies have what's called a participation rate, or they have a cap. For simplicity's sake, let's put the cap at 12%. So we'll go through on all these gains that were higher than 12%. Okay, your account would not be credited that amount of money. It would be credited the cap of 12%. All right, so these huge gains in the late 90s would have been capped at 12%, including the return of 2009, which was a rebound return. So now your actual yield goes to 7.07%. Still not that bad. However, inside an equity index universal life program, you have expenses associated with your account. You have insurance expenses, and you also have account management expenses. So what I'd like to do is just show you an actual statement from an insurance company that sets up equity index universal life programs, and show you an example of these types of costs. So here's a company that's been around for well over 100 years. Great company. I like them a lot. This is an example of one of their equity index policies from May 2009 to April 2010. So as you can see here, the account balance is roughly $3,200. Okay, the earnings that were credited during the year were 7.5%, but look at the expense charges. The expense charges were $357, and the cost of insurance charge was $55. Now, inside of these types of plans, the insurance charge is not guaranteed, and it is increasing. The expense charges are also not guaranteed. One of the other things to take into consideration is that the caps can change, and then the participation rates can change, as well as the floor can change. So you have some ambiguity as far as guarantees are concerned, and that could potentially lead to future values not being as high or what were stated on the original illustration. I feel that equity index universal life programs are illustrated at a much too high rate of return. I think that a good return to illustrate at is 6 or 7%. Even though I just showed you that there is a 30-year history with some of the best years in the market averaging out at 7.07, I still think insurance agents should illustrate at a 6 or 7% rate of return. If you do that, whole life insurance properly set up will outperform equity indexed universal life, just in the accumulation side, not even talking about the infinite banking side. So what I'd like to do is apply some of these fees associated with the policy. But before I do that, I'd also like to explain how the insurance charge works with equity indexed universal life. So equity indexed universal life was created by E.F. Hutton back in the early 80s. So it's not been around that long. And back in those days, you had a different economic environment than you have right now. I had the ability to sell universal life. However, looking at some of the uncertainty and looking at how the insurance cost structure is set up, I just don't feel comfortable with that. Even though I think it's a decent product, I think that there are products out there that can do much better. So what I'd like to do is just do a simple chart here. Okay, right here, this is going to be cost of insurance, and this is time in years. So over time, with an equity index universal life or any universal life program, the cost of insurance increases. And it's based on an annual renewable term, 1-year term. Different companies have different names for it. So what I'd like to do is bring up a very famous company and just show you how the 1-year term or the increasing cost of insurance is set up. And again, these are not guaranteed costs of insurance. They can stay the same, they can go up. You have that uncertainty. Whereas with whole life insurance properly set up, you have a fixed guaranteed cost of insurance starting day one indefinitely. The net premium on the non-guaranteed values, 610, 640, 670, 700, 750, 820, 910, 1000, 1090. The cost of insurance continues to go up every single year because obviously the older you get, the closer you get to graduation. All right, so looking at the uncertainty behind the cost of insurance, maybe in the short run that could be beneficial to you as far as accumulating cash value. However, it could be detrimental in the long run. So let's add some cost of insurance to our accumulation calculator and see what impact that has on the overall cost of insurance or overall rate of return. All right. So what I'd like to do here is take a look at that statement again that had a insurance cost of about 1.7%. I'm just going to be pretty conservative and say 0.5%. Now the cost of insurance comes out of the accumulated balance. So let's go to internal costs. Let's put a 0.5 cost in there. All right, and let's go to total earnings, internal cost. All right, so 0.5. All right, so basically this becomes your internal cost every single year for the cost of insurance. Now, could this go up? Could this go down? Sure, but nonetheless, what it does is it takes away a pretty significant amount of money from your overall yield. Now, on top of your insurance cost, you also have account management fees. I definitely think that this is a bad way to set up your policy. I think that there are better policies that exist, but nonetheless, this shows an expense load of over 10%. Okay, what I would do is maybe look at an expense load of, let's say, 2%. So now your total expenses come out to be 2.5%. As your account balance increases, so do your expenses. So in the long run, that can be quite expensive. Okay, with universal life, you also have what's called a surrender period. And so for the first 5, 10, or 15 years, you do not have full access to your account value, especially in the first year where you have extremely limited access to that. So what that shows is an actual yield of about 4.35. I've done illustrations which are more realistic that bring it down to 2 and 3%. Again, looking at the nature of these types of products, they are very expensive. There's no certainty. There are very little guarantees. And looking at the overall impact of these fees as well as the floors and caps, sometimes it's not beneficial for somebody to put their money through a product like this. Okay, hopefully this has helped out to maybe demystify some of the things associated with equity index universal life and the misfortune concept. I believe there's definitely some economic principle that's associated with the misfortune concept. I do like a lot of aspects of that concept. However, the recommendations that I give use more certainty, and if you look at the overall accumulation, it would take about 7% in an equity index universal life program to outperform a properly set up whole life insurance program. And if you again look at the differences between the two strategies, one is for pure accumulation, which is the misfortune concept. The other, which is the infinite banking concept, is to help offset the amount of interest that's paid to third parties throughout a lifetime on the big purchases that are made. For more information about our company, again, you can visit www.paradigmlife.net. And I appreciate you watching this video. Thank you, and have a great day.